Hello everyone, hope you are all doing great. Correct? Even I am also doing fantastic. In our session today, we are going to discuss Ind AS 23 borrowing cost. Students, this standard is also important for your exams. Clear? You can expect a small direct question from this standard or a part of big question from other standards like Ind AS 16, 38 and few other assets related standards. Okay? Stay focused. Firstly, scope of the standard. From the title only, we can say that the standard is applicable to accounting for borrowing costs. However, there are some exceptions. What they are? The standard is not applicable to cost of equity, including cost of preference capital that is not classified as liability. It means what? That is also an equity instrument. Let's recollect our Ind AS 32 knowledge. As per that standard, preference shares can be classified as equity instrument or financial liability, subject to requirement of Ind AS 32. Correct? If preference shares are not classified as financial liability, what does it mean? It is an equity instrument only, unless it is a compound financial instrument. Correct? So, cost of that equity instrument is also scoped out of Ind AS 23. Clear? And also the requirements of the standard we should not apply to assets measured at fair value. Assets measured at fair value also scoped out of this standard because fair value means what? It is a market based number that considers everything including borrowing cost. Clear? We should not apply the standard to assets measured at fair value. Similarly, inventories that produced in large quantities on repetitive basis also scoped out of the standard. Clear? And coming to the core principles of the standard, what is that? Borrowing costs that are directly attributable to acquisition of qualifying asset or construction of qualifying asset or production of qualifying assets must be capitalized. It means what? Such borrowing costs should be added to cost of qualifying asset instead of charged to profit and loss account as an expense. And any other borrowing cost we can recognize as an expense, no problem. Okay, what I'm saying, borrowing costs that are directly attributable to acquisition, construction, or production of qualifying asset must be capitalized, and any other borrowing cost expense to profit and loss account. That's it. In order to conclude the borrowing cost can be capitalized or not, firstly we need to know what is borrowing cost, what is qualifying asset, correct? So let's discuss one by one. Firstly, borrowing cost. These are interest cost, normal interest, coupon interest, and other costs like transaction charges, processing fees that are incurred in direct connection with borrowing of funds. And also interest expenses that we recognize under amortized cost method by applying effective interest rate that can also be part of borrowing cost. What we do as per Ind AS 109 amortized cost method, we recognize interest cost at the end of each reporting period by applying an effective interest rate, correct? So that interest can also be part of this borrowing cost. And one more thing is interest that we recognize on lease liabilities as per Ind AS 116 leases that can also be part of borrowing cost. And one more thing is this is important for your exams, foreign exchange loss. If we get any foreign currency loan, definitely we expose to foreign exchange risk, correct? If we incur any foreign exchange loss, so that foreign exchange loss also be part of borrowing cost, not 100%, only to the extent of adjustment to an interest cost. That is what the standard is saying. Let's discuss with numbers so that you can get a good amount of clarity. Okay. Assume we are taking a loan of US dollars 10,000 on 1st April 2024. On the date of this transaction, Spot rate is $1 equals to rupees 80. This is our transaction. After that, what will happen? Either we are going to repay that loan during the same financial year. If we don't repay, what we need to do? We should restate as per Ind AS 21, correct? There is a requirement from Ind AS 21. What is that? All monetary items should be restated at closing exchange rate at the end of reporting period. So in our case, it is a foreign currency loan being a monetary item. We should also restate that loan at closing exchange rate at the end of the reporting period if we don't repay during the same financial year, correct? For suppose we are making repayment. For suppose we are for suppose we are making repayment. Means what? We need to buy the dollars for repayment, correct? At the time of buying, the exchange rate may or may not equals to rupees 80. May or may not equals to rupees 80. It may be greater than 80 or less than 80 rupees. If it is greater than 80 rupees, we are going to incur exchange loss. If it is less than 80 rupees, it is our exchange gain. Correct? Or we are not repaying. We are going to restate at the end of the reporting period. In this case also, we should consider closing rate, correct? That closing rate may or may not equals to rupees 80. It may be greater than 80 or less than 80. If it is greater than 80, it is our exchange loss. If it is less than 80, obviously it is a gain. For the first financial year, for the first year of borrowing, if it is a gain, it is easy for us to recognize that gain in profit and loss account. No problem. However, if it is a loss, what Ind AS 23 is saying that you can treat this loss as a deemed borrowing cost. You can include this exchange loss in your borrowing cost, but not 100% exchange loss. Only to the extent of adjustment to an interest cost. So how to determine that deemed borrowing cost is our next discussion. Clear? Come to that. Assume we are in financial year 2024-25. We are in financial year 2024-25. There is a company called X Limited. That company needs a loan of rupees 8 lakh. For that requirement, company approached a bank in India that is offering the required amount of loan at 10%. After get to know these details, company X Limited felt that this rate of interest is very high. Thereafter, company started exploring low interest loans in the market. In that process, company approached a bank, a foreign based bank. Okay, assume it is a US bank. This bank is offering equivalent amount of loan at 4% interest rate. Assume the exchange rate, spot rate on the date of transaction, $1 equals to rupees 80. At the moment we see this, what comes to our mind first? This is low interest loan. This is high interest loan, correct? Other words, I can say that because we are getting loan from US bank, we are avoiding this high interest cost. Correct? Because we are getting a loan from US bank, we are avoiding this high interest cost. In other words, I can say that we are saving interest. We are saving interest by getting loan from US bank. We are saving the interest. After this, what is happening? Either we are repaying, either we are repaying the loan or restatement. We are going for restatement as per Ind AS 21. In either of these cases, we need to compare the exchange rate, correct? For suppose if we are repaying, we need to compare the exchange rate on the date of buying. Assume it is rupees 90. Or we are closing, we are restating. We are restating at the end of the financial reporting period. On the date closing rate is also assume it is 90. On the date of restatement also it is 90. Or we are repaying the loan, it is 90 rupees. So what we do? We need to calculate whether we are gaining or losing. We are on gaining side or losing side. So this is more than our spot rate on the date of transaction. We are incurring a loss, exchange loss, correct? How much it is? Dollar 10,000 into 90 minus 80. How much it is? Rupees 1 lakh is our exchange loss. So standard is saying that this exchange loss can be included in the borrowing cost only to the extent of this interest saving. This exchange loss can be included in the borrowing cost only to the extent of interest saving. Let's assume our interest saving is rupees 80,000. Our interest saving is rupees 80,000. So what the standard is saying that out of this 1 lakh rupees, this 80,000 is the deemed borrowing cost and this 20,000 you charge to profit and loss account. This 80,000 is deemed borrowing cost. You can include this amount in the borrowing cost and you capitalize subjected to other requirements of this standard. Okay. Assume this is not 80,000. This is 1 lakh 20,000. In this case, this entire 1 lakh rupees you can treat it as deemed borrowing cost. From this discussion, what we are understanding? What amount of exchange loss can be included in borrowing cost? Interest saving or exchange loss, whichever is lower. Interest saving or exchange loss, whichever is lower. That is our deemed borrowing cost. Let's write a steps for getting out of the confusion. Okay, let's write the steps. In step 1, we need to calculate actual interest cost. Actual interest cost. How much? 10,000 US dollars into 4% is our interest rate. We are converting that into rupees. Closing rate 90 rupees. $1 equals to 90 rupees. If question gives you the average rate, we should take average rate because it is appropriate. In ICA study material or RTP questions, average rate is not available in the questions. Only closing rate they are giving. So here also I am taking closing rate. Clear? So how much it is? $400 into 90, 36,000, correct? It is 36,000. And in the step 2, calculate the notional interest. Notional interest. Notional interest means what? If we would have taken a loan from bank in India, how much interest cost would be? That is, how much it is? 10,000 US dollars into spot rate, how much? 80 rupees into 10%. Or otherwise, you can write like this: 8 lakh rupees into 10%. Both are same, correct? On the day of taking loan. So it is 80,000 rupees, our notional interest. Now calculate the interest saving. Interest saving. How to calculate? Step 2 minus step 1. Write this. Rupees 80,000 minus rupees 36,000. How much it is? 44,000 is our interest saving. In next step, calculate the exchange loss. Exchange loss. How to calculate? Dollars 10,000 into 90 minus 80. This becomes rupees 1 lakh. Right? Our next step is determine the exchange loss to be capitalized. Correct? Exchange loss to be a deemed borrowing cost. How much? Interest saving that we calculated in step 3 or exchange loss that we calculated in step 4, whichever is lower. That is our exchange loss. We can treat it as a deemed borrowing cost. So what is the amount in step 3? It is 44,000. It is 44,000. In step 4, it is 1 lakh rupees. Lower of this would be rupees 44,000. So this is the amount of exchange loss. We can treat it as a deemed borrowing cost. In step number 6, total borrowing cost to be capitalized. Total borrowing cost to be capitalized. Step 1 plus step 5. Step 1 is our actual interest cost, correct? Because it is a foreign currency loan. Anyways, we are going to pay this actually. So that one, 36,000 plus step 5, 44,000. Total 80,000 rupees we should capitalize. Out of this 1 lakh rupees, rupees 44,000 is the deemed borrowing cost. This is the deemed borrowing cost. And remaining 56,000 is the exchange loss. You recognize it in profit and loss account. That's it. Very simple. Okay. Assume we are in financial year 2025-26. For financial year 2024-25 accounting is completed. Now we are in financial year 25-26. At the end of financial year, again, we need to restate. Or in second financial year, we are repaying the loan. Okay. On the date of repayment, either on the date of repayment or at the time of restating this foreign currency loan at the reporting period, at the end of the reporting period, assume $1 equals to rupees 85. What I am saying, whether you are going to make the repayment during the second financial year, or if you are not going to repay the loan during the second financial year, we need to restate. We need to restate at the end of the second financial year also, as per Ind AS 21, correct? So at the time of either of these two things, our exchange rate is assume rupees 85. In this case, how to deal? Our exchange rate at the end of last financial year or on the date of repayment, how much it is? This case is applicable. So this one for second financial year is applicable only when repayment was not happened during the first financial year. I mean first year of taking loan. If we already made the repayment in the first year of financial year, we don't need to discuss about second financial year, correct? We restated, instead of making the repayment, we restated at the end of first financial year. Now we are discussing about second financial year. In second financial year, at the time of either repayment or at the time of restatement at the end of second financial year, our exchange rate is $1 equals to rupees 85. How to deal it? First step, calculate the gain. Dollars 10,000 into gain how much? 90 minus 85. Our exchange rate is $1 equals to rupees 90, correct? At the end of previous reporting period. Now it is 85. It means what? We are on gain side. How much is the gain? Rupees 50,000 is our gain. In second step, you write exchange loss that we treated as deemed borrowing cost in previous financial year. In our example, how much? That is rupees 44,000, correct? 44,000. Step number 3, you write like this. Step number 1 or step number 2, whichever is lower. 50,000 rupees or 44,000 rupees, whichever is lower. What is that? 44,000 is the lower. So what we should do with this 44,000? We should reverse it. In previous financial year, we capitalized this 44,000 because there is an exchange loss. In current financial year, we are gaining. So you reduce that amount from cost of qualifying asset. That is what the standard is saying. So out of this 50,000 gain, 44,000 rupees, you reduce from cost of qualifying asset, and remaining 6,000 you recognize that gain in profit and loss account. That is what the standard is saying. I expect you are good clarity. You have a good clarity with this topic, right? So coming to the next one, qualifying assets. What is qualifying asset? That is our next discussion. Standard is saying that qualifying asset is an asset that necessarily takes substantial period of time to get ready for its intended use and sale. Substantial period of time means what? 6 months or 1 year, 15 months or 2 years. Standard has not provided any guidance about it. It is completely a judgment based, subjected to facts and circumstances of each case. That is what the standard is saying. Even I can't say you confidently substantial period of time is 12 months or 18 months or 2 years. It is completely based on judgment subjected to facts and circumstances of each case. In this definition, there is a word called sale. Means what? Asset that necessarily takes substantial period of time to get ready for its intended usage. Usage means, okay, it is our asset where we don't have any doubt. For sale means what? It is the inventory. Inventory and asset that takes substantial period of time. If inventory takes substantial period of time to get ready for its intended sale, that can also be a qualifying asset. Initially, we discussed that inventories that produced in large quantities on repetitive basis are scoped out of Ind AS 23 because they produced frequently. Here, inventories, if inventories takes substantial period of time to get ready for its intended sale, it can be a qualifying asset. If any borrowing costs incurred in connection with that, we can capitalize it. That is what the standard is saying. Clear? And next one is financial assets. Financial assets means what, sir? Like investment in equity shares or debt securities or trade receivables. They are not qualifying assets. Why? They don't take substantial period of time for intended use or sale, because at the moment we invest in those assets, they are ready, right? Similarly, inventories we already discussed. And one more thing, assets that are ready for their intended use at the time of acquisition are also not qualifying assets. Assets that are ready made, that are ready for intended use, and the date of acquisition are also not qualifying assets. For suppose, I would tell you one case. We are acquiring, this is our country. This is our country. We are acquiring a ready-made asset from another country. Okay. Just because this asset is in ready-made condition doesn't mean it is in the intended condition for usage, correct? Just because we are acquiring a ready-made asset doesn't mean it is in intended condition for usage. For suppose this country is very far from our country and this asset, this transportation takes 9 months and installation takes another 3 months. Our transportation takes 6 months. Our installation takes 4 months. It is also substantial period of time. It is my judgment and facts and circumstances of my case. So in that case, this ready-made asset is also a qualifying asset. What I'm saying? In this situation, this qualifying asset is also, sorry, this asset is also a qualifying asset, right? And coming to the next one, recognition principles. So till now, what we have discussed, we discussed the scope of the standard. After that, we discussed core principle of the standard, and thereafter, we covered qualifying asset and what is borrowing cost, right? After that, you just have a look at this recognition principle. It is same to same as per Ind AS 16. Correct? This recognition principle. See this? So borrowing costs that are directly attributable to acquisition, construction, and production of qualifying assets shall be capitalized only when it is probable that. Probable means what? More likely to happen. I can say more than 50% chances that asset will generate future economic benefits. Qualifying asset should generate future economic benefits. And cost of that qualifying asset can be measured reliably. If these two conditions are satisfied, then only we can recognize, then only we can capitalize the borrowing cost. Otherwise, we cannot capitalize. Clear? And when to start the capitalization, sir? That is our next discussion. Standard is saying that start the capitalization of your borrowing cost from the commencement date. Commencement date means what? Commencement date is a date on which all these three conditions are satisfied. Commencement date is a date on which all these three conditions are satisfied. What is that? Entity shall incur the expenditure for qualifying asset. Entity should incur borrowing costs, and entity shall undertake activities that are necessary to prepare the qualifying asset for intended use or sale. These activities are not only physical construction, these activities that are necessary to prepare qualifying asset for intended use or sale are not only physical construction, they are also include admin works like getting approval from the government authorities for starting construction or planning or designing of that particular qualifying asset also. Okay. Let's assume we are taking a loan. We are taking a loan on 1st April 2024. This is a date of loan. On 1st June 24, we are incurring cost on qualifying asset. On 1st August 24, we started activities. Let's assume we applied for getting permission for construction of qualifying asset from government authorities. So out of these all dates, which date is satisfying all conditions? 1st August, correct? So 1st August is our commencement date. So from this date, whatever the interest cost we are incurring, we can capitalize. Any interest cost that we incurred before means from 1st April to 1st August, this you expense to profit and loss account. That is what the standard is saying. Yes, sir. We know the commencement date. When should we stop the capitalization? Till long time, how much time we can capitalize? And at what point of time we should stop the capitalization? That is our next discussion. Okay. Standard is saying that if active development of our qualifying asset is suspended due to any reason. For suppose COVID-19 came, government imposed a 6 month lockdown. In that lockdown period, no worker came for work. Our active development of qualifying assets suspended. So during that period, we should also suspend capitalization. It means what? Borrowing costs incurred during that period, we should charge to profit and loss account as an expense instead of capitalizing to cost of qualifying asset. However, in normal delays means what? It is not an extended period. In our example, due to COVID-19, active development of our qualifying asset is interrupted that resulted to extended periods, correct? For suppose workers don't come on Sundays, they don't work on Sundays. Do we need to expense the interest cost in connection with that Sundays? No. That is a normal part of construction process. In that case, we need not expense to profit and loss account. It means that we need not suspend the capitalization. And in some another cases, while construction going on, 5 days or 1 week break should be there. We should not do anything during that period, 4 days or 5 days or 6 days before going for next activity. So during that period also, we should not suspend the capitalization because they are normal part of construction process. Clear? So this is all about temporary suspension, means temporary stoppage of capitalization. Now we are going to discuss permanent stoppage. When should we stop permanently the capitalization of borrowing cost? Standard is saying that when substantially all the activities necessary to prepare the qualifying asset are completed for its intended use or sale, as the case may be, you can stop. Thereafter, we should not capitalize. We should charge to profit and loss account. That's it. Standard is not saying 100% should be completed. Standard is not saying that 100% should completed. Standard is saying substantially all activities completed, you stop the capitalization. It is not necessary 100%. Clear? And normal routine administration work spending, you should ignore that. You can stop the capitalization. Not can, you should stop the capitalization. Okay. Like decoration of properties, that and all. Okay. And next one is, if construction of qualifying asset completed in parts, if out of all construction activities, if one part is substantially completed, borrowing cost to the extent of that completed part should be ceased. Example, we are constructing we are constructing 5 buildings in a business park. This is a business park. We are constructing these 5 buildings. So this first building construction substantially completed and remaining 4 buildings construction in progress. Standard is saying that borrowing cost that is in connection with this portion, this building, you cease to capitalize. That is what the standard is saying. Clear? And next one, standard is saying that, of course, standard is providing a separate provisions for specific borrowings and general borrowings. How to capitalize, how to calculate the interest cost that can be capitalized in case of both specific and general borrowings. Let's discuss. Firstly, specific borrowings. Specific borrowing means what, sir? These are the borrowings, they are the loans that we acquired, that we get specific to construction or production or acquisition of our qualifying asset. They are very specific. In that case, we can easily identify the borrowing cost. We need not do so much hard work to calculate. In fact, in our exam also, it is very, very easy thing for us. Simply you take the loan amount multiplied with the percentage of interest and period, you will get the amount of borrowing cost that required to be capitalized. However, if we invest that borrowed funds temporarily anywhere, be it a fixed deposit or any other ways, we should reduce the temporary income from the borrowing cost. That net amount only we should capitalize. For suppose we have taken 10 lakh loan on 1st April 24. Out of this 10 lakh, 5 lakh rupees we are incurring today, and remaining 5 lakh rupees we are going to incur on 1st October 24. So during this 6 months, what I did is the balance 5 lakh rupees I invested in fixed deposit at the rate of 8% interest. So in this case, what we need to do is assume this 10% loan is 10 lakh loan is at 12%. So borrowing cost to be capitalized in this case. How much? 10 lakh into 10%. No. Our example 12%. Correct? How much sir it is? 12. 1.2 lakh. Less FD income. How much it is? 5 lakh into 8% into 6 by 12. You will get some X amount. So this net amount should be capitalized. Right? And next one is general borrowings. This is important for your exams. Okay. So what is general borrowings? Sir, if it is not a specific borrowing, we can say that it is a general borrowing. Yes, you are correct only. If borrowing is not a specific borrowing, it is a general borrowing. For suppose we are having a 12% debentures, 10% working capital loan, 8% term loan. We cannot map these loans one to one to the qualifying assets. They are general borrowings. So how to calculate the borrowing cost in this case and what amount should be capitalized? That is our next discussion. Before going to that, let me tell you one thing. For suppose, in this example, our construction completed. In this example, our construction completed on 31st December. Let's assume our construction completed on 31st December. This specific borrowing is still outstanding. This specific borrowing is still outstanding after construction. So that specific borrowings becomes general borrowing because our construction of qualifying asset is completed on 31st December. Thereafter, it will be part of general borrowings, right? So how to calculate the interest in case of general borrowings? Let's see the theory first. After that, discuss with numbers. We will get clarity, okay? See, all borrowings that are not specific represents general borrowings. First one. When general borrowings are used for qualifying asset, Ind AS 23 requires applying a capitalization rate to the asset's expenditure to determine the borrowing cost eligible for capitalization. Fine. Let's discuss that. What is capitalization rate? Capitalization rate is a weighted average borrowing cost of all general borrowings outstanding during the period. It means what? Specific borrowings we should not consider. What is that formula? Total interest cost on general borrowings, weighted average general borrowings outstanding during the period. You should very careful with the denominator. Standard is saying that it is weighted average general borrowings, not just outstanding borrowings. It is weighted average general borrowings. We will discuss while doing the question. Okay. And how to calculate? Firstly, we need to calculate the capitalization rate. As we discussed, this is the formula. After that, we need to calculate the weighted average expenditure. We are not going to apply that capitalization rate on outstanding borrowings. We are going to apply that capitalization rate on weighted average expenses that incurred on qualifying asset, not on outstanding borrowings. Okay. And after that, we will get to know what is the amount that is eligible for capitalization. You just multiply step 2 into step 1. Right? Sir, as we discussed, we should apply the capitalization rate on weighted average expenditure incurred on qualifying asset. So what is that expenditure? What are all the costs we can include in that expenses? Standard is saying that expenditure that have resulted in payment of cash payments only. It is not on accrual basis, right? And transfer of other assets. If we transfer any asset, like we are holding a cement bags, For construction of that qualifying asset, we are using that cement bags, include that cost. And assumption of interest bearing liabilities. If we are assuming any liability in connection with the construction of our qualifying asset, that can also be included. And these two we should reduce from the expense. What they are? Any progress payments if we receive, reduce it. Grants, any receive, your grants also reduce. Clear? So let's discuss with the numbers so that we can get good clarity. Assume we are having two loans. They are general borrowings. 10% debentures, rupees 10 lakh, and one more 12% working capital loan, that is 10 lakhs. Okay. This is our general borrowings. We don't have any specific borrowings. For the time being, assume we don't have any specific borrowings. So how to calculate the borrowing cost to be capitalized? Before going to that, on 1st April 24, assume we are in financial year 2024-25. These two loans are outstanding. Okay, these two loans are outstanding. 1st April 2024, we incurred 5 lakh rupees on qualifying asset. On 1st July 24, we incurred another 5 lakh. On 1st January 24, we incurred remaining 10 lakhs. Now, how to calculate the borrowing cost? Step 1, calculate the capitalization rate. How to calculate the capitalization rate? First, numerator 10 lakh into 10% plus another 10 lakh into 12%. This is our interest cost, correct? Divided by weighted average borrowings outstanding during the period. Next, 10 lakh debentures. In our example, these two loans are outstanding throughout the financial year. That's why I am taking 12 by 12. For suppose, if these debentures were issued on 1st July 2024, if these debentures issued on 1st July 2024, in this case, instead of writing 12 here, we should write 9 by 12. Right? This is very, very important. You should be very careful at this point. Are you able to understand what I'm saying? In first discussion, I have taken 12 by 12 because that debentures are outstanding throughout the financial year. After that, I created a situation. What is that? These debentures were issued on 1st July 2024. It means what? The debentures were outstanding for 9 months only. So we should take 9 months. Okay. And coming back to our original situation. Okay. And this is not 9. 12 by 12. So how much? 10% into 10 lakh into 10%. 1 lakh. Correct? This is 1 lakh plus 10 lakh into 12%. It is 1 lakh 20,000 divided by 10 lakh plus 10 lakh. How much, sir? 20 lakh. Calculate the percentage. 2 lakh 20,000 divided by 20 lakh. 2 lakh 20,000 divided by 20 lakh. How much it is? It's 11%. 11% is our capitalization rate. And next, calculate the weighted average. Calculate the weighted average expense incurred on qualifying asset. Calculate the weighted average expense incurred on qualifying asset. So let's start. 5 lakh into how much? This is outstanding for 12 months. This 5 lakhs is outstanding for how much, sir? 9 months. This one, 3 by 12. So now you write 5 lakh into 12. 5 lakh into 12 by 12. Next 5 lakh into 9 by 12, correct? 9 or 6? 9. And next 10 lakh into 3 by 12. So you will get one amount, correct? What is that? 11.25. 11.25 lakh. And next step is you apply the capitalization rate on step 2. It is simply 11.25 lakh into 11%. How much it is? 11.25 lakh into 11 percentage. It is rupees 1 lakh 23,750. So this is the amount we can capitalize. But I can suggest is that before finalizing this number, let's check with actual. Let's check with actual borrowing cost on general borrowings. So in our example, what is the amount of actual borrowing cost? This numerator only, correct? This numerator is our actual borrowing cost. How much it is? 2,20,000. You compare this number with actual borrowing cost and lower can be capitalized. Lower can be capitalized. For suppose, in our example, if this number is not 1 lakh 23, it is, let's assume, 3 lakh rupees. It is not appropriate to capitalize 3 lakh rupees when our actual interest cost is 2 lakh 20,000, correct? So we should definitely compare our actual borrowing cost with this number. Okay, let's do one more question for good clarity. We are having a specific borrowing. We are having a specific borrowing of rupees 5 lakhs. This is at the rate of 10%. We have not invested anywhere temporarily. Okay. Second one, we are having two general borrowings. 10% debentures of rupees 10 lakh, 12% working capital loan for 12 lakh rupees. Okay. And on 1st April 2024, we are incurring rupees 6 lakh. No, it is not 6 lakh. It is 4 lakh. 1st April 24, we are incurring 4 lakh. On 1st July 2024, we are incurring 11 lakh. On 1st January 2025, we are incurring another 12 lakhs. So which is equals to total borrowing, correct? Right. Now how to do the capitalization of borrowing cost in this case? First thing, you capitalize interest on specific borrowings. How much it is? 5 lakh into 10%. How much it is? 50,000 rupees. You capitalize this. In second step, firstly we need to calculate the capitalization rate, correct? So calculate that capitalization rate equals to how much? 10% of 10 lakh, 12% of 12 lakhs. Same, I guess. 10% of 10 lakh, 12% of 10 lakh divided by, assuming here also these borrowings are outstanding for entire financial year. If they are not outstanding for entire financial year, we should take weighted average in terms of months. In our previous example, I said that for suppose debentures were issued on 1st July, it means what? They are outstanding for 9 months. We should take 9 by 12. Clear? Don't forget that. That is very important. And next, 10 into 12 by 12. So this, as usual, capitalization rate will become 11%. That we have already solved in previous question, right? And now second step, it's calculate weighted average expense incurred on qualifying asset. This is the next step. So let's calculate. Here you should be very careful. Why? There is a specific borrowing. There is a specific borrowing of 5 lakh, correct? So out of 1st April 2024 expenses for 4 lakh, assume this 4 lakh is incurred from specific borrowing. And next one, this 11 lakh. Out of 11 lakh, 1 lakh incurred from specific borrowing, and next 10 lakh is from general borrowing. And this is completely 12 lakhs, correct? It is. This 12 lakh is completely from general borrowing. Clear? Assume this is 10 lakh only. 12% working capital loan. This is 10 lakh, not 12 lakhs. Okay. Here, this one also 10 lakh. Here also 10 lakh. Okay. For convenience purpose, sir. And here 10 lakh. This is correct. Capitalization rate, because we have taken 10 lakh here, right? Not 12 lakh. So fine. What I'm saying, out of this 4 lakh, I mean, this 4 lakh is incurred from specific borrowings. Out of this 11 lakh, 1 lakh rupees incurred from specific borrowings, and remaining 10 lakh from general borrowing. And this 10 lakh is, this general borrowing only. Now come. This we should ignore. This 10 lakh. 12 by 12. No, not 12 by 12. 1, 7 means what? 9 by 12. Here it is 3 by 12. 10 into 9 by 12, 10 into 3 by 12. Plus 10 into 3 by 12. How much? 10 into 3 by 12. 10 into 9 by 12. 10 lakh only, no? What, sir? Yeah. 10 lakh. Okay. And third step, you apply the capitalization rate, 10 lakh into 11%. How much it is? 1 lakh 10,000, correct? As I said, before conclusion, let's check with actual borrowing cost. How much it is? This numerator, 2 lakh 20,000, correct? Versus 2 lakh 20,000, whichever is lower. This one is lower, correct? So this amount we can capitalize. And next example, it covers 2 financial years. Okay, it's very important for your exams. Be careful. Assume construction of qualifying asset takes 18 months from 1st April 2024 to 30th September 2025. It means what? Financial year 2024-25 and financial year 2025-26. For first financial year, it covers 12 months. Second financial year, it is covering 6 months from 1st April 2025 to 30th September 2025, correct? For convenient purpose, I am not taking special borrowings, because special borrowings is very simple. We are not going to consider special borrowings in calculation of general borrowings, correct? I am not taking special borrowings. Let's assume we are having 2 general borrowings. One is 10% debentures of rupees 10 lakh, and another one is 12% working capital loan. 12% working capital loan of rupees 10 lakh. These two are our what? General borrowings. Okay. So expenses incurred on qualifying asset. Expenses incurred on qualifying asset. That is our next details. Assume 1st April 2024. Our expense is 5 lakh rupees. And next one is 1st October 2024. Another 5 lakh. And next 1st January 2025. Another 5 lakh rupees. And 1st July 2025 is another 5 lakh rupees. Total 20 lakh rupees were incurred for 18 months. So from this list, we can say that first 3 expenses are related to financial year 24-25, and next one is related to financial year 25-26. Correct? One important point we should keep in our mind is second financial year covers only 6 months. It means what? We should capitalize the interest cost only to the extent of 6 months. Right? So let's start. First one, we need to calculate the capitalization rate. Capitalization rate. How to calculate? What is the interest cost? 10% of 10 lakh plus 10 lakh into 12% to general borrowings. Again, I am repeating, we should consider the period of time that loans outstanding during the financial year. In our example, let's assume these two loans are outstanding throughout the period of these two financial years. Okay. In our example, we are assuming that these two loans are outstanding throughout the financial years, two financial years. If in exam, if the loans are not outstanding throughout the financial years, we should very careful with the denominator. We should not take 12 by 12. That is, I already discussed in previous two examples. Okay, very careful. So next one is what? That is also 10 lakh into 12 by 12. This is same example. We will get 11% as capitalization rate. Correct? Now in second step, calculate weighted average expense incurred on qualifying asset. Weighted average expense incurred on qualifying asset. That is next one. So what? This 5 lakhs, 5 lakhs, 5 lakhs. These three expenses incurred in current financial year. Okay. All these are for current financial year only. First we are in current financial year. Financial year 24-25. This is first financial year. I mean current financial year, first financial year. Weighted average expense incurred on qualifying asset. So first 5 lakh into how many months it's outstanding? It outstanding for total year. Next 5 lakh. First October. It means what? 6 months. First October to 31st March. Next. First January. Next 5 lakh is first January. It means 3 months. Calculate how much? Here 5 into 3 by 12. 1.25, and this one is 2.5, and first one is 5. So it is 8.75 lakh. Correct? And in third step, simply you apply the step 1 into step 2. Correct? Step 2 into step 1. That is 8.75 lakh into 11%. That will become 11%. 0.9625 lakh. It's nothing but 96,000, right? So we should not ignore actual borrowing cost. Correct? Actual borrowing cost. How much it is? 2,20,000. Our numerators are this numerator 2,20,000. Okay. So whichever is lower, which one? This 96,250 is the borrowing cost that should be capitalized. Okay. As we already discussed, actual borrowing cost, if actual borrowing cost is less than the determined number, in that case, actual borrowing cost should be capitalized. So that's why I'm saying that the step 3 number or actual borrowing cost, whichever is lower, that should be capitalized. Okay. So till now, how much amount our qualifying asset carries? Carrying amount of qualifying asset. This 5 lakh, 5 lakh, 5 lakh. Correct? Total 15 lakhs plus this interest 96,250. Total 15 lakh 96,250. This is the amount our qualifying asset carries.
And now coming to next financial year 2025-26. In this case, first the capitalization remains the same, capitalization rate, because as we discussed, loans are outstanding throughout the financial year, that is 11%. Now step 2, weighted average. Weighted average expense incurred on qualifying asset. You should be very careful on this step because we are in second financial year. Firstly, we need to start with opening balance 15 lakh 96,250. This construction is going to be completed on 30th September. It means what? 6 months outstanding. If construction takes entire second financial year, we can take 12 by 12. In this case, construction is going to be completed on, see here, 30th September. It is only for 6 months, correct? So 6 by 12. And next one. Next expenses. What is the expense? This one, correct? 5 lakh. On 1st July. July, August, September. 5 into 3 by 12, correct? 5 lakh into 3 by 12. So how much it is? 5 lakh into 3 by 12. This one plus 15 lakh 96,250 divided by 2. Total 9 lakh 23,125. The third step you apply the same. Step 2 into step 1. 9,23,125 into 11%. That will become 1,01,543. Anyways, as usual, compare this with actual borrowing cost, whichever is lower. Obviously, this is 2,20,000. So this will be capitalized. In this example, what is the important thing is we should start with opening balance. What is that? This opening balance includes general borrowing cost that we have capitalized in previous financial year. Correct? What is that amount? See here. This we capitalized. We already included this 15,96,250. Correct? See here 15,96,250, which includes general borrowing cost that we have capitalized in previous financial year. You should be very, very careful on this part. Right?
Yes, we completed the general borrowings. And next one is capitalization of borrowing cost in case of group financial statements. So in this case, we should think from group point of view. Group point of view only we should think. For example, there are a group of companies. This is X Limited and this is Y Limited. Assume X Limited is a parent company, Y Limited is a subsidiary company, and there are some other subsidiary companies. Okay. X Limited taken a loan. X Limited taken a loan from bank. Y Limited is constructing qualifying asset. In separate financial statements of X Limited should not capitalize the interest because X Limited is not constructing any qualifying asset. In separate financial statements of Y Limited should not capitalize any interest because Y Limited don't have any borrowing, correct? It is just constructing the qualifying asset. From group point of view, in consolidated financial statements, there is a loan, there is a qualifying asset. So in group financial statements, we should capitalize the borrowing cost. In separate financial statements, we should not. One more situation. For suppose this X Limited not taken loan from bank. What happened is Y Limited took a loan from X Limited. Y Limited took a loan from X Limited and Y Limited constructing a qualifying asset. X Limited, Y Limited. Y Limited took loan from X Limited.
and it is constructing qualifying asset. In separate financial statement of Y Limited, we can capitalize the borrowing cost because it has taken a loan from parent X Limited and qualifying asset is also constructing, correct? However, in group financial statements, that intercompany transactions eliminated, correct? Intercompany transactions eliminated. It means what? No capitalization. That is what the standard is saying, right? And coming to the next topic, cessation of capitalization of maturing inventories. Some inventories takes very long time to becomes mature and held for sale, like wines, whiskey. Okay, for that kind of inventories, it is very difficult to say a point of time at which maturation process completed. So what the standard is saying that if entity can demonstrate that maturation process is still under progress, yes, you can capitalize the borrowing cost. If entity cannot demonstrate the point, entity cannot demonstrate that maturation process is still under progress, in that case, cease capitalization of borrowing cost. That is what the standard is saying. For suppose we are manufacturing whiskey wine. This is the time cycle, assume. So at what point of time our whiskey manufacturing process is completed, that maturation process completed? If entity can demonstrate that it is still under progress, yes, you can capitalize. If entity cannot demonstrate that point, stop the capitalization. You classify that inventory from being mature to being held for sale. So thereafter, you recognize as an expense whatever the borrowing cost you incurred. So with this, I am concluding our discussion on Ind AS 23 borrowing cost. Okay, let's see you guys in the next session. Bye bye.